Well, this is Muhurat Trading happening in case of commodities at CNBC TV 18. I'm Manisha Gupta, wishing you all a very happy and a prosperous Diwali and a very good New Year as well. Well, this year clearly belonged to gold and silver. We did see all-time highs in both of these commodities, and they have continued to run on the higher side. Whether it has been about central bank buying or the rate cuts coming in from the global central banks, it also had to do with a lot of safe haven buying and portfolio diversification. All of that led to all-time highs in gold and silver. And as has been said that in last 20 years, 17 years have given you positive returns and perhaps double-digit returns as well in case of gold there. Silver clearly has been a bit of a lackluster for many years, but this year has seen breakup on higher side. And with the markets anticipating that this could just about continue, there are deficits in the global markets and you could be looking at all-time highs going forward, especially for the Indian markets there. We are joined by a host of experts right now. Max Layton is the Head of Commodities at Citi. We have Kunal Shah joining from Nirmal Bang, and we have Chirag Sheth from Metal Focus. Gentlemen, hi, thank you so much for joining us, and a very happy Diwali and a prosperous New Year going forward to you. Max, I want to start with you, and I want to start with gold first of all, and the kind of gains that it has put on table, more than 35% gains in this year. How have you seen this year, and what's your sense now going forward with the kind of fundamentals that you would want to watch out for?
Gold's had a spectacular run this year, of course, up around 35%. There's been many different drivers, and I would say the different drivers are not the normal historical drivers over the last 10 to 15 years. You've had central banks really step up. You've had China really step up, certainly for the first half of the year, and that's transitioned into North American, European, global ETF buying in the third quarter of this year. China stepping back, on paper the central bank stepping back a little bit, but overall investment demand for gold this year has been super strong. It's come from different sectors, as I mentioned, over time. It's shifted over the last 9 months exactly who's buying how much, but wow, it's been a spectacular year for gold investment demand so far, and we expect that to continue over the next 6 to 12 months.
So, Max, what are the targets that you're looking at in sense of gold prices going forward, let's say, for 6 to 12 months?
Yeah, I mean, overall, considering some of the data that's gone against gold, strong payrolls, big rally in rates over the last few months, it's been a very steady, positive momentum bull market in gold, and we haven't changed our forecast for some time. We've been targeting $3,000. Well, I think at least since the start of this year, potentially since the end of last year. And that is where we expect to be over the next 6 months. And we're expecting it to, I mean, of course, there could be volatility on the way up, but target remains $3,000 an ounce.
Max, also, how are you looking at silver then? Because we've seen 12-year highs in the global markets, but the Indian prices have seen an all-time high here. Silver is part safe haven, and then there is a lot of investment demand, and we also have seen industrial demand come in for this one. What is your sense on how should we be looking at silver now?
We've done a lot of research on silver over the last 6 months in particular. This is a market which on paper has been in deficit in the vicinity of 15 to 20% of annual consumption every year for the last 5 years. And we think that underlying deficit is driving a turnover in silver inventory. So bar and coin inventories are turning over with the kind of historical lower cost buyers of silver selling their stocks to new investors at higher prices. And so as that stock of bar and coins turns over, and we think almost half of that bar and coin stock has turned over the last 5 years, you need higher and higher in prices to incentivize the new holders to sell to meet the deficit. In other words, every month you need silver. On our numbers, silver is so fundamentally tight that you need 1% of the existing stockholders of silver to sell their stocks every month to clear the supply and demand balance. And that's something which is driving all these dynamics are driving higher highs and higher lows in silver. This fundamental backdrop is not enough to drive silver to the moon on its own, but it is certainly something that drives a sustained kind of higher highs, higher lows, certainly over the last couple of years. The next leg higher in silver and gold, in our opinion, is all about the sustained slowing in the US labor market over the last over the next 6 to 12 months. It's been slowing for 2 years, according to a number of different data points. We've had a little bit of a stabilization in the last couple of months, but we expect the trend to continue towards weakening because the Fed's way above neutral. On the Fed's own numbers, neutral's around 2.93%, and interest rates are well above that level. So we'd expect the US economy to continue to gradually slow down, people to continue to remain concerned about asset price downside in that environment, and that's going to drive ETF demand, bar and coin demand, the next leg higher over the next 6 to 12 months, and that's what we see taking both gold and silver substantially higher over that time frame.
So, Max, if you're looking at $3,000 an ounce in gold in the next 6 months, what are you looking at in sense of silver forecast in the next 6 to 12 months?
Yeah, so when we ran the balance numbers for 2025, for example, we assumed $40 silver, and then we adjusted the jewelry demand lower in response to higher price, adjusted the scrap supply higher in response to higher price, and we still come out with a deficit. So even at $40, we are thinking that $37, $38, $40 in that kind of range, we're still seeing that the silver fundamentals require investors to sell their stocks to clear the market. And that underpins our bullish view on silver, and we're targeting over the next 6 to 12 months, $40 an ounce.
Max, stay on with us. We'll get some sense from the experts joining in now. We have Chirag Sheth and Kunal Shah on the show as well. Chirag, what's your sense? Citi says $3,000 in 6 months for gold and $40 in next 6 to 12 to 18 months for silver as well. How would you look at the price forecast going forward from here until next Diwali, let's say?
So we are very much in the same range. We look at $3,000 by Q1 2025, and then probably market goes into a bit of consolidation phase. However, we are far more bullish on silver. We believe that the market, as it was pointed out by a previous speaker, that the market is in a deficit, and the deficit has been increasing for quite some time. We believe that the demand for silver from electrical vehicles, from solar, are likely to see robust growth, and that will push silver higher above $40. And we believe that to 18 months at least.
Also, since we have you with us, seen in gold and silver both.
I think a lot of us who look, given the fact that prices have increased by 30% over the last, essentially you are looking at volume to be about flat to marginally negative. In the current scenario, that is extremely robust, given the fact that where gold prices have been, even if we end up doing 5 to 10%.
Kunal, hi, thank you so much for joining as well. When we look at last 5 years or 10 years or 15 or 20, or rather very stiff competition to other asset classes as well. And with the way we are trading at all-time highs right now for both of these commodities.
The outlook for next couple of years continue to remain very bullish, and I will have to revise my target for upward revisions, 3,200, 3,250. The long-term trend continues to remain very bullish going forward. So even after delivering extraordinary returns from last 2 years and over last 5 years, we continue to believe that gold is likely to give conservatively 10 to 15% annualized return to the investors. And there is no doubt about it. But if the situation or the scenario, so if Fed goes for the aggressive rate cuts going forward, or there is a major geopolitical escalation in the world, I think it can really reach all the prescribed targets by the experts, and it can really shoot up quite higher. But let us be conservative, and let us say that 3,000 to 3,200 looks very realistic going forward. And short-term corrections, profit taking will keep coming, but the underlying trend for gold very, very, very strong.
Oh, well, yes. Let's not forget that we will be looking at a lot of volatile moves going forward in the next 1 year, but gold and silver are the place to be. This one is to you, Kunal, yet again. How would you advise investors or buyers to buy into gold right now? Because sovereign gold bonds is not available right now, but a lot of people seem to be finding various newer ways to buy into it. So whether it is about funds, ETFs, futures, even there are so many, new companies that are getting listed right now. So buying stocks within gold and jewelry as well.
Well, I think the best way investors can, as of now, can have a exposure toward gold is definitely gold ETFs. They are one of the smart way. If you want to have a paper gold on your books, then I think gold ETFs are the smart choice, and one should keep adding gold ETFs. Second, sovereign gold bond. I don't know when the tranche will come, and there is no announcement by the formal announcement by the government. So number one, ETF. Number two, obviously, you can go for buying physical gold and keeping into the vaults. That is not advisable in today's era. So I would continue to remain with the ETF. As far as the proxy, a gold jewelry company, or I think that is more to do with the consumer-driven story rather than the bullish trend in gold. So most of the listed jewelers, they are basically hedged by 75 to 80%. So I would say that's a consumption story. So
Okay.
there is no proxy, there's no gold mining stock in India, but I think gold ETFs is my favorite one, which I'll recommend to investors to invest in.
All right, point taken. I would want a statement from you as well, Chirag, onto that one on what is the best way of buying, what kind of portfolio diversification can commodities give to you, and what is that one thing that you will watch out for in sense of Indian market context when it comes to next 1 year?
So I think, look, I would say, anybody should have at least 5 to 7% of gold in their portfolio. And that exposure, as Kunal has rightly pointed out, can come through ETFs, sovereign gold bond, or physical gold. I think what is very interesting, Manisha, in last 1 year, what we've seen is that how a lot of investors have shifted towards physical gold. We estimate that in 2024, we'll see about 200 to 230 tons of retail investment buying, that is in terms of bars and coins. And this would be the first time since 2014 we'll see, this kind of number. So this is a very significant development which has happened in last, 1 year. In terms of, one thing which in the Indian market, I think what is going to be very, very interesting is that how the consumer adjusts to higher prices. As pointed out by everybody, we could see another 10% jump in gold prices over the next 1 year. Probably the share of 18 karat, 14 karat jewelry will increase. In absence of sovereign gold bond, physical demand will continue to also push up. So I think these are the two things that I'm watching very closely.
Well, it's going to be a volatile and a promising year next year, but gold and silver are the place to be. A double-digit percentage portfolio diversification in gold is something that you could perhaps look at. Chirag, thank you so much for joining us and talking about gold and silver. With that, we'll take a break. Well, we've talked about the precious metals, but after the break, we'll touch upon the industrial metals as well, where the demand seems to be increasing. And in this year until now, for copper, aluminum, zinc kind of metals, we've seen a double-digit growth here. We'll also talk about the energy markets because that impacts India a lot. So what's the sense going on there after this very short break? Well, a lot of people in the market would tell you that this year belongs to commodities, and going forward, as we see global demand recovery and the China demand getting better as well, the metals perhaps could continue to go higher. In any case, for the Indian markets as well, the way we're looking at infrastructure, elections and a lot of construction as well, metals perhaps could be the place to be. Max, I want to come to you first. And what's your sense on industrial metals now? Because we have seen good gains for copper, aluminum, zinc, not so much for the other ferrous metals. But where are you putting your bets?
There's a lot of things that can happen to metals, both bullish and bearish, and a lot of binary risks upside and downside just in the next couple of months. But taking a 6 to 12, 18-month view, we think the copper and aluminium in particular are going to do very well. Middle of next year, we've got copper at 11,000. We've got aluminium getting up towards the high 2,000s or almost $3,000 by the second half of next year. And both of those markets are underpinned by strong China-led energy transition demand growth, a lack of supply growth, and likely substantial investor interest in a global manufacturing recovery. And we think that will be that's the base case, certainly by the second half of next year and into 2026. And that's, that investors are going to express that view, in our view, through copper, and it's going to take aluminium higher with it. Zinc's got some special supply stories at the moment, which we're not assuming that they last, taking a 12 to 18-month view. So, yeah, super near term, very difficult on base metals because, for example, Trump may win the US presidency and then may proceed to do very large Section 301 tariffs on China very quickly in the first quarter of his potential presidency next year. And that would be a major headwind for metals. Our base case is that China responds to that kind of trade escalation, trade war escalation. But obviously that would, raise significant uncertainty about the degree of the global recovery in the second half, 2025, 2026. So, there's some water under the bridge between now and our base metals bull market call over the medium to long term to be had. And that's part of the reason we're so focused on gold and silver higher is partly because elsewhere, it's much more questionable. Gold and silver seem to work in most of the scenarios that we look at over the next 3 to 6 months.
All right, Max, we hear you that you have most bullish bets lined up in case of gold and silver, not so much in industrial commodities. But the other one really has been crude, and positive for India because we import 88% of our requirement, and crude oil prices are down by 15 to 16% in last 1 year. What is your sense? Do you see further declines coming in for crude prices going forward?
Sure. I'll start with where I think we're heading. The path to how we get there is very dependent on what happens in the Middle East over the next couple of days even. But we're heading towards an average price next year for crude oil of $60. That's where we think roughly the equilibrium is, considering the very high spare capacity in the market, considering the non-OPEC supply growth that we forecast is significantly higher than global demand growth that we forecast next year. These bearish dynamics, I think the market has generally moved towards consensus on. I would say our average price forecast is well below consensus. But I think we're on track. It's just in the very near term, there is a real potential for escalation that includes oil assets. To the degree that it is contained escalation, I think selling those rallies, especially those clients who are significantly exposed to crude oil.
All right, so gold and silver it is, and not so much for industrial metals, and sell every rally that you see in crude oil prices. As Max says, the Citi house view is that $60 a barrel is a possibility in 2025. What is your sense, Kunal, especially when it comes to industrial metals? While we have seen prices come off its lows, but they are way off its highs, and we are stuck somewhere in the middle. How would you want to look at this segment?
We believe that the fundamentals of crude oil is not looking very positive until and unless we have a major geopolitical disruptions in the Middle East, where the oil production gets badly hit. That's the scenario when oil can really shoot up. The fact remains is that the OPEC compliance is likely to get weaker going forward because each and every Middle Eastern countries would like to increase their revenue, and the only way they can do it is by increasing the oil production. Remember, OPEC has been giving signals from last 3 months that in the month of December, they are going to increase their production. But the prices have already fallen recently. So there is a talks in the market that they may not increase the production. But the fact is, the compliance will likely to get weaker, and the oil supplies are going to get a major boost going forward. Russia is likely to pump more oil, at least 1 million barrels of more oil than what it pumped in 2024. So I'm not very optimistic about the outlook on oil. I think for the Brent, $80-$85, for the WTI, $75 to $78 seems to be the top. And on the downside, we are of the view that it can go down and test and remain at $60 to $62 per barrel going forward in the year 2025.
All right. So stay invested in gold and silver. Those can give you double-digit returns. Metals are going to be stuck in a range, but crude oil prices is a definite sell. All bearish cues coming in for that one. Kunal and Max, thank you so much for joining us. Very happy Diwali to you as well. So that clearly is the scene coming in for commodities. This definitely is a place to have it in the portfolio. The diversification clearly has helped people. It has given 35% of returns when it comes to gold, 45% up for silver. And in the last 1 year, it has been 20 to 25% of gains that we have seen come in for various industrial metals as well. So it has clearly given you a very happy, precious Diwali there as we can see it. But with that, that's all the time that we have on the show. Wishing you all a very, very prosperous year going forward.